Let's start. Let's continue from where we left in the previous session. A very, very good evening. We started the introduction. Small part of the introduction is left. We'll finish it off, and then we'll move to uh, one of the chapters, which will build up our base for the subject. Now, before I move forward, voice is audible. Na? Before I move forward, I think, though I told you it's a fast track batch, but I think you are in ultra fast run. Nifty is about to touch 21,000. I don't know whether it wants to finish off so soon. We cannot be so fast. Today, it again touched almost 20,900. Maybe you will not get the feel till the time you do a derivatives chapter. Anyone, by the way, just a 2 minutes warm up by the time students come in. Anyone who tracks equity markets or invests some part of stipend which you get by chance? No, no, limited resources you have, I know, but when we are looking, especially you are a CA, I cannot speak this in normal circumstances. If we look at, this was again 400 plus, and I think Nifty is 20,855. This is the highest level till now. I think if it opens tomorrow, we might touch 21,000, which was supposed to be expectation was it will take another 6 months time. But I think you are in a hurry, your batch is in a hurry, even Nifty is in a hurry. So the benchmark index, if actually you believe actually what kind of valuation standing, since you will have a lot of valuation in your course, so I'll just tell you so that when you look at the markets, you should know what exactly this means. The valuations are standing very rich. When we call this word, it means they're standing very high level, and huge amount of expectation is there from India. If anything happens slightly, anything happens, this will fall drastically. What it means in, for example, when you go for the exam and you expect I'll score 80 marks and you end up scoring maybe 70. 70 is not bad in the CA final, but expectation was 80 and you score 70, your mood will be off. Exactly same thing is market is. So I expect that you would have opened the paper today. In case not, tomorrow open it up. In case every day form a habit, only 2 more minutes I'll take. Just before the sports column, at the end where you watch India has won from Australia, India is playing World Cup, etc. You have a habit of watching the matches. Small 5 minutes time spent on this financial market, because day in day out when you join a company, on an average 10 years time you would be CFO level after becoming CEO. And the job of CFO is not this accounting, not the GST return. It's about capital structuring, raising of finance. What should I take the decision? What planning should I do? Where should we spend so that the value of the firm increases? What you have learned, there are two functions which you'll be doing at a very high level. That's procurement of funds and utilization of funds. If I tell you about your inter, the first lecture when teacher teaches, he would have told you it's a procurement and utilization of fund. Exactly same thing. And unless until you yourself know how value is created for shareholders, we cannot make it out, especially during this time. This is the best time, and maybe I think you are in the best era as of now when you are standing here. The best time it could be possible in the lifetime of a chartered accountancy, because if the economy grows, automatically you have to grow along with this, because there are only handful of CAs. The way the industries are going, the way the SMEs are going, the way the markets are going, the way the finance would be coming to the India, the management is up to you. With that, I'll not take more time. We'll move to the part now. What we were doing in the previous session, I'll continue from there. Last note we wrote was beta, I think. Now, how the application of beta will take place, we'll learn today. I'll slightly increase the speed today. Beta was a relationship. Now we are moving to another note from your inter level, which we used extensively throughout the finals. Note number this was, I'll continue from here only, 10th note number. Only date has changed, note remains 10. Methods to calculate KE. Methods to calculate KE. Any popular methods you remember? KEs are what? Cost of equity. You had full chapter called cost of capital, in which you calculated cost of preference share, cost of debt, cost of equity. And then there were some methods to calculate cost of equity. Any methods you can tell me. Wrong or right, that's perfectly fine. CAPM one was not the method. CAPM was capital asset pricing method. In fact, that is the most used practical method, and maybe I think one of the extensively used, or only one of the method which is used, CAPM method. That has some beauty which we'll learn today itself. Any other method? Theoretically, you have learned one method which was theoretically used a lot in the inter level. Dividend growth method. It could be dividend growth method or dividend discount method. That was D1 divided by net proceeds plus G used to do, or it could be D1 divided by price plus G. Actually, that was not a discounting method. That was basically a valuation method, which I think you would have done in your dividends chapter also. The value of the equity, intrinsic value when you calculate, it's D1 divided by K minus G. We'll be using all these terms. I'm just roughly using what is intrinsic value, what is price, because some of the chapters will be based on these formulas only. And then you would have small off track method. Two popular methods what you've learned is, one is dividend growth method or dividend discount method. You used to call dividend growth because it was G was used growth, and dividend discount is actually that formula is not d1 by p plus g or d1 by net proceeds plus g. The correct formula is, it's a valuation method, price or intrinsic value is d1 divided by k minus g. It's a discounting method, perpetuity formula. What we'll learn in one of the chapters, we have security valuation, so we'll do extensively that formula. So I'll make four popular methods which will be used at your level. Two of them are very important, rest two will be there. First was dividend discount method. You can write down the full form, please. Dividend growth method. Sir, why do we have these names? Write it for the time being. We'll do in detail when we move to the chapter. Dividend discount, DDM. The dividend discount method, dividend growth method. Second is CAPM, capital asset pricing model. A very, very, very important method. Capital asset pricing model. Third is earnings yield. Yield. And you know, yield is nothing but return. Return when compared to what price? Face value or market price? Market price. Yield is a return with respect to the market price here. And fourth is given by Institute of Chartered Accountants, ICAI. DDM, KE formula used to be. Just write the formula in detail. We'll do in the subsequent chapters. It is D1 divided by P plus G. Actually, correct formula was D1 by net proceeds plus G. D1 stands for, sir, what? D1 is equal to dividend for next year. Dividend for next year. P stands for price. And interchangeably in inter you would have used the term net proceeds. And G stands for growth rate. G stands for growth rate. Under the clouds, whatever I do, that's part of Siva. Only for your reference purpose. You will retain it, will not do in the exam. The formula actually is, which you'll be using in the finals or you would have done. The DDM is dividend discount method, DGM is dividend growth method. Growth comes because of the G. Why do we use dividend discount method? The formula of the price is equal to D1 by K minus G. It's a perpetuity formula. In detail we'll do when we move to the chapter. Although it is not required, if you say, I'll do in the depth. Otherwise it's a perpetuity formula. It's perpetual growth. Prima facie it appears only D1. It is not D1. It's a dividend from 0 period till infinite. It's a perpetuity formula. GP series is applied, some concept is applied, so this formula comes out. We'll see when we move further. That's a K formula. It's, sir, how does it come? If you try to look at this formula, if G goes here, it's a K minus D. If you try to decode this formula, this will be exactly same. This will be exactly same. Practically used and the most celebrated formula is CAPM, capital asset pricing model. It's a very, very important formula. I'll do it. I'll just write the formula in detail. Subsequent note I'll make it. Can I move down? I'll write out CAPM formula. KE. Actually, correct term is not KE. RE, required return. There is a small difference between KE and RE, but your institute at your level, theoretical level, it's interchangeably used. Cost of equity, required return, expected return, all are one and the same thing from perspective of exam, unless and until question gives a specific term. RE is required return. Let me tell you very frankly what it means is, for example, I expect 50 marks in my exam, but requirement is only 45. So there could be difference between expectation and requirement, and what you actually get. There could be all three could be different. When we move into portfolio, I think, or maybe mutual fund at some extent, I'll show you that what exactly how do we read KE and RE. So if you write KE, it's okay, but when you go to the practical life, if someone asks you what is KPM gives you, KE or RE, you have to say RE. If you say KE, your interview would be over then and there. He'll not even ask you say KE is only for purpose of exam. It's a required return, RE, technical word. As of now, I'm putting KE. It's RF. Anyone remembers the formula? RF plus beta into RM minus RF. RF is equal to risk free. Just put down the words. In depth, we'll do it. Risk free rate of return. Very, very important formula. It's the beta coefficient. Beta coefficient. RM is return from market. And I hope you know what market is now. Market is Nifty or a Sensex. Return from market. And RF you know is risk free. Sir, what is RM minus RF? RM minus RF term is market risk premium. MRP. It's a market risk premium. Just write down the names. Once I start with the KPM formula, I dictate what exactly it means. How do we read this number? I'll be able to read this number, don't worry. How to read this formula? Need another 2-3 minutes time. RF plus beta into RM minus RF. Third formula, earnings yield, is only theoretical. You'll be using maybe at a CA final only when you get stuck at other formulas. Otherwise, third and fourth formula you might not be using in practical life. I'm saying it again. Fourth, only formula, the formulas which will be used in your exam to the maximum extent is first one and the second one. Third formula you'll be using in case you get stuck. Some people have a habit of looking earnings yield. KE is equal to, yield is with respect to market price, and we are looking at EPS. It's EPS divided by what? Price into 100. Some people look at earning with respect to price. Sir, why do we use this as a KE? Actually, KE is nothing but return from the investor's point of view. What is cost from the company's point of view is return from the investor's point of view. So, if for example you look at, I invest 100 rupees and my earning is 20 rupees, what is the return I am getting? The return which investor is getting is a cost from company's point of view. So, how does it justify? If you slightly remember your capital budgeting or balance sheet first function, if this is a company will do only two functions: raise money from the investors. This is one function of the company, and they'll invest money where? In the projects. That's the asset side. That is the asset side. When they raise money from the project, if they're raising from equity shareholders, it's called KE. If they raise from debt, it is called KD. If they raise from preference share, KP. So it's a cost for the company. For investor, it is what? Return. So you have to also remember that what is the cost from the company's point of view is return from the investor's point of view. Second, when company raises money, same thing I could have done in the T format balance sheet. You raise money from here, that is called procurement of fund, and then second function comes utilization of funds. And when you utilize the funds, what company earns is nothing but called R, which you have used term as return on equity, return on investor investment, or return on shareholders fund, etc., depending on who has applied the money. Or you could have called return on capital employed. So only the entire financial management will revolve around two functions only. One is called procurement of funds, raising of the funds. Second is called utilization of funds. This is return. How do we look at them? How do we compare? These all will come in the part final level. Inter you would have done, but maybe you would not have spent time. Logically now they'll understand that if I'm raising a money, at what rate I'm raising a money, and what is the return which I'm getting from there. So this is called return. It's a company. This is the asset side of the balance sheet. Left hand side is the liability side. No need to draw in the subsequent chapter. I'll tell you draw. If you want to draw in rough, it's okay. Otherwise, in the subsequent chapters, I'll tell you what exactly this means is. But remember in the mind, it's a procurement and utilization of fund. If it's a cost from the company's point of view, this is cost from the company's point of view. It's a return from the investor's point of view. Return means, let's suppose I invest in Reliance today. Reliance prices could be 2,500, let's suppose, and I'm getting the earning of the company is 200 rupees. So I invested 2,500 rupees. I am earning 200 rupees. That's a return from the investor's point of view, and company will treat it as a cost. Similar formula is this also. The dividend compares dividend with the price. Earnings compare EPS with the price. But these formulas are not used aggressively. Next, last formula which is given by your institute is K is equal to 1 by price earning ratio. That will be only used at final level. So how that formula comes? If I try to decode this formula, what is the formula of price P ratio? Price by EPS. Price by. If you look at this formula, it becomes which formula only? First one. 1 by P ratio is nothing but it's earnings yield only. If you try to look 1 by P ratio, it's a 1 divided by P ratio, 1 divided by price by EPS, it becomes EPS by price. At final level, is this used? Yes. In practical life, no. This will be used at the final level. Quickly copy that part, please. And then we move to the KPM. Done? Let's write down the heading as KPM. CAPM. You cannot tend to forget CAPM. It's till the last class, I think almost, we would be using somewhere or the other CAPM. Almost every chapter, some or the other place CAPM would be used. CAPM. KPM. Tell me the formula. KE is equal to RF plus beta into RM minus RF. KE is cost from whose point of view? Company. And from investor's point of view, it is return. Now let me ask you some questions. What is the beta of risk free? Beta of risk free beta. What is beta, by the way? Is beta is a measure of risk? Measure of risk. What is the beta of risk free? 0. Beta of risk free is equal to 0. There is no risk in the risk free. Beta of risk free is equal to, I'm taking some numbers, no need to copy, I'll make that as an example only. Return from market is 10%, or return from risk free 10%, return from market is 15. Do not copy anything, I'll make that as an example. I'm making this ratio now. How much return I need without taking any risk? Risk free 10%. That means if I take 0 risk, I need how much return? 10. Beta I am not putting here. Market is giving me how much return? 15. Risk free is giving 10. Please do not copy. 10 plus beta into what? 5. Let me try to read this number now. No need to copy. I'll make this an example only. The way of reading this is I need minimum 10% return without taking any risk. When I take a risk, what is the beta of the market? 1. Beta of the market is 1. If I take a risk equal to beta 1, I need excess return 1 beta minus 0 beta. 15 is 1 beta, 10 is 0 beta. I need excess return of how much? 5%. Now I have not put the beta. This is a general equation. Now depending on these securities, let's suppose you are investing in a risk free, the beta will become what? 0. If it becomes 0, answer would come what? 10. If you invest in a security whose beta is 1, Answer will be 15, and it has to be 15. Market is giving you how much return? 15. What is the beta of the market? 1. So market is giving 15 return. If I invest in a security whose beta is 1, my return would be equal to 15. If you invest in a security whose beta is more than 1, you would expect higher return than the market or lower return than the market? Higher return. So put 1.5 beta. Let's suppose I invested in a security whose beta is 1.5. Automatically 10 plus 1.5 into 5 percentage. If I invest in a security whose beta is 0.8, my answer will be 10 plus 0.8 into 5 percentage. This is called Kapam equation. This is a standard equation, sir. Does it mean that if all of us invest in the market, our standard equation would be this? Yes, market for me and you both are same. Risk free for you and me both are same. What changes is I am investing in Bharti Airtel, you are investing in Idea. I am investing in Indus Tower, you are investing in some other company. So what will change is this beta would change. Accordingly, risk will change, and the moment risk changes, the return would change. Sir, how do I read this 5%? 5% is excess return from the market at beta equal to 1. MRP. If I have to read MRP, what is MRP? MRP is difference of RM minus RF. RF has 0 beta, RM has 1 beta. RM minus RF is excess return from the market at beta equal to 1. That is the market beta. The moment you invest in a security whose beta is more than 1, return expectation more than 1. Sir, but we have written the cost. Cost is from the company's point of view, return from the investor's point of view. I'll put down the example now. Data. Sir, that means in exam, if any question comes in which you have to use different type of betas, always frame Kapam equation and then keep substituting what? Beta factors. So if the beta is more, you'll come to know if the beta is more, return expectation will be more than 15. If the beta is less than 1, return expectation would be less than 15. Let's put down the example. Just copy this part. Beta of risk free 0. Example. Now, calculate K using following data. Calculate K using following data. Calculate K using following data. RF 10%, RM 15. Give me 4 5 beta factors. You only give and we'll create the equation. Beta, what should I take? Different. I'll take 0, then second one. Give me any numbers of your choice. 1, 1.5, 1, 1.5, 0.8. So basically I have 0, 0.8, 1, 1.5. Solution as per Kapam. As per Kapam. K is equal to RF plus beta into RM minus RF. RF is a constant number here, 10 percentage. Beta is a variable number here, in minus K is equal to 10 percentage. This is called Kapam equation. This is called Kapam equation. Now we can substitute. Sir, how do we read 5%? If you want to write, you can write for a reference. 5% is excess return from the market when the beta of the market is equal to 1. It's an excess return. 5% is excess return from the market when the beta of the market is equal to 1. Beta of market is always 1. MRP, basically I am dictating MRP. MRP is excess return from the market at beta equal to 1. First beta I'll take here, beta is equal to, so my K. Sir, can we verify the answer? At least logically you can verify. If your beta is less than 1, your answer would come less than 15 percentage, less than market. Finish it off, all three parts please quickly. Finish it off, all three parts. Done. How much do we get? First part answer. It should be equal to risk free. 10 percentage. Second one 14. It is less than market because your beta is less than 1. Third case you have 1.5 na? No, 1. If the beta is equal to 1, your return would be equal to market. And last one is it goes in line. If you take higher risk, your return expectation will be higher. That's it. My objective is you should be able to read this beta because I'll be applying this with some different formulas, APT world, etc. So exactly this formula I'll replicate, I'll read from here and create my new formulas. KPM formula is the most used practical formula. Now we can also write one theory part using this, which will be part of the portfolio. I can do it here. When we graphically draw KPM, CAPM, it becomes security market line. Security market line is a graphical representation. Second important part is KPM is a finance line. What is a finance line, sir? We'll be learning some finance line and some statistical line also. Finance line is a line that will mean that even without taking any kind of a risk, I need some minimum amount of a return. It will always start above zero. So there are some financial management line, there are something statistical line. Statistical line can mean without taking at zero, I can have a negative return, I can have a positive return. In the case of a finance line, my finance line will always start above zero. That means I need minimum return without taking any kind of a risk. KPM is a finance line and the name we give it security market line. You can put down SML, security market, security market line. It is graphical representation of graphical representation of graphical representation of KPM. As per me, this is straight only. This is your beta. This is your, you can call it as AE. ER is expected return or RE. Anything we can call it as. Although interchangeably they are used, I'm just putting here. You can watch the line first and then help me out. When beta is 0, how much is the return I expect? How much is the return I expect? 10 percentage. Second beta, what I assumed was 0.8. If the beta is 0.8, my return expectation was 14. Then we increase beta to what? 1. The beta is 1, my return expectation is 15. Then we increase beta to what? 1.5. Return expectation was 17. This is basically tells me 1.5 and this becomes what? Anything above 1 is known as aggressive beta. Below 1 is a defensive beta. It's a graphical representation of KPM. So what does this line tells us? This line tells us, if you look at the line, this tells us lower the beta, lower is the return expectation, higher is the beta, higher would be the return expectation. And when I say a finance line, what I meant was the finance line was even without taking any kind of a risk, my return expectation was what? 10 percentage. We need a minimum return even without taking risk. In India, for example, sir, what is risk free? By the way, any asset which is risk free in the world, there is no such asset called risk free in the world. But for the purpose of valuation, we use the safest instrument of that particular country as a risk free. For example, when we are standing in India, what do you think? Who will default at the last? IL default, articles will default, then whether the companies will default or the governments will default. Who will default at the last? Or if out of all the Iraqi, one particular party defaults, that means everyone is assumed as a defaulter in that country. Bank can default. One bank default does not mean every bank will default. Go back and today check what happened with Sri Lanka, what happened with some of the countries. Who do you think in India, for example, if I take, which instrument do you think will last be defaulting? And if that defaults, that means everyone can default in that particular. It is government. Government does a lot of borrowing. That means when we say which is the safest instrument we consider here, PPF for example, or some NSE bonds for example. I'm just taking a name of them. If they default, then everyone is considered defaulter. Sri Lanka, for example, Sri Lanka has come to that category. Greece at one point of a time defaulted. The government said we cannot repay the debt. The moment government says we cannot repay the debt, then leave apart the individual who will repay the debt. But that's not a issue which we'll be discussing here. When we move to the subsequent chapter, I'll tell you, because the countries are given credit ratings. That ratings would be very very important. For example, when you give the ratings to the movies, it's a triple A, double A, B plus, double B plus. That tells you the security of your money with that particular company or with that particular country. So risk free, when we'll talk about, I'll tell you. Although at your level it is not required to go into that discussion. Also, how do we calculate risk free? Questions will always give you. But when you move to the practical side, if you're doing valuation in India, there will be different type of risk free. If you're doing valuation in the US, or if you're doing valuation in the European, any of the UK company, or let's UK, or let's suppose you're doing in the France, or you're doing the Switzerland, there will be different RFs could be there, because they'll have a different scenarios there. So every government have different kind of a rating. That's not the task here. My objective was only to tell you we need minimum return, and if return is higher, if risk free is higher, it means risk free higher only means is, or interest rate higher only means is, safety margin is less. For example, if I am assumed as to be a least defaulting party, then I will not give you more amount of interest. For example, let me do it in a simple way. If I go today as a chartered accountant and take loan from the bank, and you go as an article and take loan from the bank would charge higher interest from you. The reason being because your repaying capacity is lesser. There could be chance of default is more. It is not that they will not give you loan. They categorize accordingly. So you should know that higher interest rate economies are not considered by the way to be that great. Because if the interest rate is higher, that means borrowing cost of that country is. But my objective here was only that at without taking any risk, we expect a minimum amount of a return. That was KPM. We'll be using this a lot going forward. This note number, you have given this note number or continuation only? KPM? If you want, you can give. If you've given 11th number, you can give 11 number here. And then 12th number is again one of the important parts we have. Did I tell you, did anyone had a doubt yesterday? Face value was rupees 10 of the MRF, and share price was 1,11,000 something, 10,000. Now why such a difference comes in the share price and the face value? I'm taking that number now. You have done in your inter level, but maybe you don't remember it. Let's put down 12th note. That's this one. Book value. Book value per. To understand a difference between the share price and the book values, let me draw a small balance sheet. In fact, this also you have done in your cost of capital, but maybe you're not able to recollect it. I'm assuming this is balance sheet of any big brand. You can assume you take a sweet house, it could be Dadu's, it could be Haldiram's, or etc. Anything you can take it up. I'm just assuming someone started his company with share capital. Just a small number I'm taking. Share capital started 1 lakh shares into 10. How much capital he introduced? Hmm? 10 lakhs. 10 lakhs. Then over the period, he earned some reserves and surplus. Would be 90 lakhs. You know what is the total of this is known as share capital plus reserves and surplus. Share capital, this is only equity. Share capital belongs to whom? Equity share cap, equity holders. Reserve surplus, only equity shareholders. This is known as equity shareholders fund, or we can also call it as book value. Book value of this company is total book value. Companies, total book value of this company is 1 crore. If I ask you calculate book value per share, how would you calculate? Book value per share formula would be equal to what, sir? Total book value divided by what? Number of equities. Will be 1 crore divided by what? Divide by how much do we get? Maybe you can stop writing for a minute. What is the face value of this company? 10. What is the book value of this company per share? You might have done something called calculation of cost of capital based on the book value based on the market price. Cost of capital based on the book values based on the market price. And there could have been a possibility when you did based on the market price, you would have ignored the reserves and surplus. Now understand what I mean is, just keep in mind the example of MRF. 10 rupees face value is this. Book value includes what? Reserves and surplus. So difference between face value and book value is reserves and surplus. It means, sir, what it means is 4,100 rupees MRF was earning as EPS, and they were distributing, I think, 170 rupees as dividend. Every year what happened? Balance part keeps adding to what? Balance sheet, and reserve surplus increases. Second important part. This is accountancy now. This is pure accountancy. Third part. If let's suppose I go to him today and tell him, it could be any established business. I go to him today and tell him, I want to buy your business. Do you think will he sell to me at rupees 100? You've done some chapters in the accountancy also based on that. I go to him, I tell you that you introduce 10 rupees. Over the period, your reserve surplus are 90 lakh. Per share book value comes 100. Sell me your business at 100 per share. What do you think he'll sell me? He'll ask something what? Goodwill. You have done something called goodwill. What you call goodwill is actually, we call it as a future expectation. Goodwill is nothing but the efforts what I have put in my business till now, which will give me results in the coming years. If I roughly, I am saying this is not the exact way of calculating the share price. If I add to this book value the future expectations, that becomes a share price. If I add to it, for example, that means, sir, if I add to it what you call in accountancy as goodwill, we call it as future expectations. Sir, what does future expectation mean? For example, any company announces that we are coming out with a new project, the share price of that company goes up drastically. It's only the future expectation, and this becomes nothing but share price oblique the price in the market. How do we calculate future expectation? Can we do it? We have lot of methods to estimate future expectations. That means if I do my business, then at what rate it will grow, to what extent it will grow, and so on. The increase in the market, what happened yesterday and today after the election result, is only a future expectation. Nothing has changed. It's only expectation is building up that in the next 6 months, 4 months time, new government will come. They will make up the strong decisions. The countries will grow, companies will grow, etc. That's called future expectation. It means, sir, what if difference between book value per share and share price is high? That shows future expectation is high, or expectation of that company is high. Generally, in the bullish trend, gap between book value and the price would be higher. If there is a bearish trend or a recession in the economy or slowdown in the economy, the book value and share price difference would be lower. Sir, do we calculate? We will be calculating this in different chapters, how to calculate. We have complete chapters of valuation now. It's something will come here that will be including here, but you should know, if someone says why MRF price is 1,11,000 when the face value is 10, you should be able to answer difference between 10 and 1,11,000 is because of two reasons. One, reserve surplus gets added. If that gets added, we get book value per share. If we add future expectation, that means in the coming year, because businesses are going concern, it's a perpetuity concept. Until the end, whatever earning comes, do we have the option to discount? We have. When we discount the future earning and add to the current level or calculate the valuation, we get at share price. Does that share price reflects exactly what we calculate? Maybe no. What we calculate is intrinsic value. What appears in the market is a demand and supply. For example, when you go from home, you want to buy a tomato and your mom says 50 rupees kg tomato will come. That's a fundamental price. But when you go to the market, he might charge you 70 rupees, he might give you at 40 rupees. That is depending on demand and supply. Anything which appears in the market is because of demand and supply. What we calculate is fundamental value as per us. We have lot of methods to calculate fundamental value. Now you can copy that note. Quickly copy that note. This note is book value per share. Basically, it's capital plus reserves and surplus will give you total book value. We can call it as a equity shareholders fund. ESH is nothing but equity shareholders fund. Book value per share is nothing but book value divided by number of equity shares. Difference of face value and book value per share is reserves and surplus. If we add goodwill, what you call in accountancy, in finance we call it as future expectations, it becomes share price. These terms will keep coming to us in different chapters in different forms, and when we'll come back, I'll tell you go back to your introduction class and look at these notes. That's the basic of introduction we have done. Some more I could have done, time value of money and so on, which I'll do with the respective chapters, and how to read time value of money, mathematics, etc. This is the introduction we are done here. Can I move forward? We'll move to, we'll start with, in fact, a new chapter. In fact, the first chapter what I'll start. This chapter will help us in building a base so that you get affection to the subject. Easy chapter, question comes almost on and off. Almost 5 to 8 marks will find the question here. We are starting a new chapter called mutual fund. A very important chapter from examination point of view. Mutual fund. Approximately, we can find questions ranging from 5 to 8 marks. Practical theory both can come, but it's a practical heavy chapter. Practical and even theory can come. And if your luck is good, it can be 10 marks also. It's 10% of weightage. It's one of the easiest chapter we can have. Does not require any kind of complex mathematics. Every one of you would be hearing what mutual fund is when some big cricketers comes for the advertisement. And since we are a cricket loving country, so they come plan for your retirement. There are some cricketers who come that it's the mutual fund. Mutual fund is nothing but it's an indirect way of investing in the market. Nothing but indirect way. For example, you're a chartered accountant, you do not have a time to look into the market. You ask some professional to manage your money. That's the professional would be portfolio managers, those who keep take care of your money via mutual fund. That's it. It's professionally managed money. Doctors, engineer, etc. Everyone can give. And in the recent last 2 3 years post COVID, so much money has come to the equity markets. You can thank you to the mutual fund, and you can thank you to the retailers. Foreign investors are not the buyers. If I would go before COVID and stand the way selling has been done by the foreign institutions, market would have fallen. This market what you see 21,000 approximately today, Nifty would have been not even 12,000. But the way money has been given from the public to the mutual fund, and mutual fund is investing aggressively in the market and then sitting on a huge amount of a cash. They do not let the market fall. And that's why I'm saying, if by chance public start withdrawing the money, then there could be some danger which can come out, which I'm not able to see. A price which pre-COVID was 100 rupees of a company is touching 1,000 rupees now. I don't know what has happened to those kind of a companies. So do not get mesmerized by the market, please. You have to be very careful. I'm saying it again. Market thrills, but it kills also very. It looks very. You have not seen the crashes. You would not have seen the 1992, 93 that point of a time, 2000 or 2008 Lehman Brothers crisis, COVID. After that, everyone was sitting home, nothing to do. Equity market cut, invest, and the money has come because of the online. Because it's so easy, click of a button, invest, and everyone has become advisor. Everyone has become advisor. They have not even seen single crisis. A single crisis, if you want not to demoralize you, please. Reality, I'm telling you. Just go and try to watch 2008 crisis of Lehman Brothers, subprime crisis we call it as. COVID leave apart. 2008. That one. Some of you said bank default. One bank defaulted, and throughout the world crisis happened. And you will not imagine the if I tell you the numbers. If the share price in January 2008, let's suppose, was 200 of a particular company, then after 7 8 months time, that was trading at 40 rupees. It was a pure example of wealth destruction. So there could be destruction of the wealth also. But yes, after 2 years, everything recovered back and came out. But problem is, you have not seen that kind of crisis. 70 80 lakh rupees of a portfolio came down to 20 lakh rupees. Your hard earned money in which you pay the taxes, and that come down. So you have to be very careful. But as of now, we are standing in a very bull run. So I don't want to demoralize you that do not invest. It's a instrument to invest. Mutual fund generally gives you lesser return than the direct investment, and because you systematically invest over a period of a time. Similarly, if the return is lesser, risk would also be lesser. For example, if today Nifty is standing 21,000, no matter which type of companies they are investing, they'll invest at this level. If next month the Nifty is, let's suppose, 20,000, so whatever investment will happen at lower level. Automatically, average out will take place. So mutual funds have done a huge role in the present market, and this is because of the investors. In fact, one homework I give it to you for your own work. Just look at the number of demat accounts which has opened in the last 2 years. You come to know what kind of a trend has happened. If they were standing, I think 1.5 crores, I would not be surprised. I think it could have reached even approximately 10 crores. Just go back and check. That means you'll come to know how aggressively public is investing. Last week IPO came, Tata Technology. IPO price was 500 rupees. Opened at what date, 1400. Means if you invest 14,000 rupees in a 1 week time, 14,000 plus 14,000 plus 14. 21,000 profit approximate. You got the application? Oh my god. Eh? Made not. I'll take my words back. Made the application, not allotted. You can imagine the kind of money people. If suppose, let's suppose, I do not want to even give you the confidence of investment also, because if you start making money, you will not come for the class. He will look very ordinary. Like if he would have made that application would have come to him, let's suppose 14,000 rupees, and I think now it does not take even more than a week time. Within a week, everything happens. Application, allotment, listing. India has become so fast, and if you end up getting that money, your interest on the CA would itself go. Because in a month, even if you make one application, and there is hardly any risk, especially the IPOs like Tata's or Irida came, 5 IPOs came last, and everyone gave a decent return. One of my cousin, he invested, he is invested in a lengthier application, 10 lakh rupees he invested in one of the IPOs, I think Irida or somewhere, and he was allotted maybe 6,000 share, I think. Out of 10 lakh, he was allotted for what, 2 lakh 50 or 3,000. 3 lakh rupees, 6,000 share, 32 rupees was the price. Irida would be possibility, and that price went within 2 days of listing 70 rupees. You can imagine 6,000 into 30 how much. If by chance one application you make, the entire stipend money comes. So this is actually fascinating everyone. I put my disclaimer. I tell every class same thing I'm telling you. If making money was so easy in the equity markets, then no one would be doing any other job. You have to be careful. Any person who can manage his risk will be able to earn money. And when you invest in such a way, it is not 5 days, 10 days, 1 year. There could be a possibility 2 years you will not get any amount, and then there will be 1 week entire earning would can happen in the 1 week time. You have to invest exactly that way. So if your parents would be telling you not to invest, maybe they would have seen some bad time, hence it is there. But to you, why I tell you, because you'll be soon part of this financial market. You should be knowing, even if you're not investing now, at least you should read and know. Means it's not necessary that you have to do something and tell. You should be able to talk. For example, if he's able to talk, maybe he's investing. It is not necessity. For example, IPOs, I hardly invest in IPOs, so it does not mean that I do not keep a track of it. You have to be able to speak to common friends. For example, some of your friends could be engineers, doctors, etc. This is a common topic on which you can talk endlessly. If I start talking, I can talk throughout the night. X number of share, X number of plus minus. I sleep also market, I eat also market, I drink also market. Subject somehow is this only. That's my passion actually. I love. But it's not that I invest and I make for the purpose of money. It's only the thrills. But since I've seen some circles over a period of a time, so you have to be, the fresh investor should be very careful. Please. It's not every time you'll get the money. There could be 1 month of a crisis, everything can be gone. But if you would not have borrowed or leveraged your position, that means you've not taken a loan from someone, you need not worry. Sit quietly. 6 months time, 1 year time, 2 years time, your money would come back to you. But those who borrow or leverage their position, they wind up very soon. There is no end to it. But the reason I told you was, this is the mutual fund who has let the markets reach such a height. Tata Technology is one of them. Any other IPO applied for? No. There were a lot of IPOs which came. Hmm? Flair came, Gandhar came, lot of IPOs came last week. Anyhow, this chapter is simple. Doing wise, by today itself you'll come to know the simplicity of the chapter. Objective is, we cannot tend to make a mistake in such simple chapters. These marks have to be in pocket. I'll just draw what it means is, this is mutual fund. This is called investor market. If you directly invest in the market, we call, you have opened your account, that's a direct investment in the market. If you invest with the help of the mutual fund, it's a indirect way of investment in the market. That basically indirect investment in the market. And market, as per the SEBI guidelines, market whatever return mutual fund gets, they have to return back to the investor, but obviously they'll charge their fees, extra professional charges. Advantages of mutual fund: I do not have to keep track of which company is good, which company is bad, what to take, what not to take. Second advantage is, MRF share was 1,11,000. If I go today, I have to give 1,11,000 to buy one share of MRF. But what the mutual fund can do is, they can collect money from small public like us, 5,000 rupees, put it in a basket and go to the market and buy one share. So I can indirectly become, although in the books of the company, mutual fund would be the shareholder, but indirectly I am owning the shares. What we can do is, we can give our preference. Sir, invest my, when you invest in mutual fund, they'll ask you whether you want to invest in the equity funds, whether you want to invest in the large companies, whether you want to invest in the small companies, whether you want to invest in the dividend paying companies, whether you want to invest in the growth companies, which type of a sector you are looking for. Are you looking for defense sector? Are you looking for the auto sector? Are you looking for the banking sector? That preference you can give, but you cannot tell them which company to invest. That decision will be taken by the mutual fund professional. So briefly, I'll dictate some sentences. In this, it will be basically making our base work for the practicals. This is, I'll dictate some sentences. Quickly put down these points. First point: mutual fund collects. Mutual fund collects. Mutual fund collects money from the like-minded people. Mutual fund collects money from the like-minded people. Mutual fund collects money from the like-minded people and invest in the market. Mutual fund collects money from. Why do we call her like-minded people? Like-minded are, for example, if one segment of this, for example, they say we want to invest in auto, so there could be auto sector. This says we want to invest in technology, there could be technology. Like-minded people, they would. Disclaimer again, I am putting: any advice, any discussion done in the class, whether it's a positive or negative, do not assume it to be a buy or sell advice, please. It's only since I track market, since my subject involves market, it's for education purpose. But certainly I know that this market has given return to the people who have stayed invested. Simple I can tell you is, the Sensex, if it is standing at 68,000, it was 100 rupees in 1979. Nothing to be done. Those 30 companies basket, give to the mutual fund, ask them to invest in the index fund, make an index of it. Your money will automatically grow. You do not have to worry about it. Why we lose money is because of FNO, derivatives market. When we go to the FNO, I'll tell you. And if you have the, since you have the demat account, when you open, I think one disclaimer would be coming to you. 90% people lose money in the FNO market. It's made mandatory by the SEBI, I think. Everything will come. That means 90% people lose money in the FNO market, derivative market. That is part of your course. We'll do a lot of questions. When I'll do the questions, feel, oh, so good. 1 rupee investment becomes 10 rupees. FNO is such a part. That's one part. Actually, share market is huge. One is called cash market, one is called derivative market. This is, derivative market is extensively part of your course. No matter, it will thrill I saying, whenever I teach that chapter, everyone assumes in 5 days only will become crorepati, billionaire. But no one becomes. 90% people lose money in that. Do not try to touch that out, and that is only thing which I think your parents would be discouraging. When you go and ask them, they'll tell you FNO, futures and option. What I am telling you, these are cash market shares. There is a difference between that. We'll come back to it. So disclaimer I've told you, but certainly I would love during the batch. Last time I'm saying it, during the batch I would love if you get momentum, gain some confidence in you, read something. At least you can speak on the economical growth of your country. And what has happened in the last 2 years, you cannot imagine unless and until you're part of this one. I'm saying it again. People have generated so much of a wealth in the last 2 years, which entire last 10 years keep aside. Cannot even imagine. I cannot name the companies. There are n number of companies. I held some of them company paints for 10 years. From 20 it moved to 60 only. The moment I sold, the line which you move, that line starts moving what? Faster. And I sold, and within a 1 year, that 60 rupees became 2000 rupees. I'm not able to sleep. My father tells me every day. Means, how can you know 9 years I held? I'll show you that share sometime when we have security analysis chapter. There are few companies. One of them was Hyderabad based company. Hyderabad based company. My student told me when I was teaching, sir, this company is into this business, they do the research. So I took some number of shares. 9 years, nothing happened. And then suddenly COVID comes, technology came. That because of the technology, that company moved. Hyderabad based company. Anyone knows any company which moved from 20, 30, 40 rupees to the 2000 rupees? Very good. No, nothing to be done. I'll tell you when we move. But I could not make money. These are painful things which comes. So history changed post COVID. What you think is not there. It's a change which is coming very quickly. First point was like-minded people. Second point put down, please. Second point put down. The money so collected by mutual fund, the money so collected by the mutual fund is invested as per the money so collected by the mutual fund is invested as per the preference of the investor, is invested as per the preference of the investor. So what does it mean, preference of the investor? Under that you can put down a bullet. Preference of the investor basically means is you can advise them, invest my stocks only in the Nifty 50 share index fund, invest my shares only on the auto companies, invest my money only in the banking companies. That you can tell them, but you cannot tell them which companies have to invest it. Under this, put down a bullet. Can be invested in, can be invested in index funds. Index is Nifty Sensex, auto sector, banking sector, etc. Third point. Now before I dictate third point, you tell me, when investor invests the amount in the market or any company, what are the type of return you expect from it? For example, I bought a share of Reliance. What do you think I'll get from that? One in the form of dividend, second in the form of capital appreciation. Capital appreciation, if I sell, it will be booked capital gain. If I do not sell, it will be unrealized capital gain, means increase in the value. Now, if mutual fund is investing in the market, now mutual fund is the shareholder. What do you think return will be in the hands of mutual fund? If I invest directly, I'll get capital gain, I'll get dividend. If mutual fund invest, what do you think mutual fund will be getting from the market? It, I can invest in Reliance, for example. Even mutual fund can invest in Reliance. If I am getting dividend, do you think mutual fund also gets dividend? Yes. If I get capital gain, do you think if mutual fund will also get capital gain? Yes. If they sell, it will be realized capital gain. If they do not sell, it will be what? Increase in the value. So basically, it's a shareholder only. So mutual fund generates two type of return: one in the form of dividend, second in the form of capital gain, and they'll distribute to you. They will distribute to you. Although they give only one type of return practically, but for the exam perspective, will show if mutual fund earns dividend income from the market, and if they distribute, question will say dividend distribution. If they earn capital gain from the market and they distribute, they'll call capital gain distribution. So language theoretically they'll use same. They will not use different. Let's put down the third point, please. Mutual fund generates two types of return. Mutual fund generates two types of return: dividend, second is capital gain. Mutual fund generates two type of return. Next point, fourth. Mutual fund returns. Mutual fund returns the return to the investors. Mutual fund returns the return to the investor. Sir, what does it mean? It means if mutual fund earn dividend from this, if they dividend declare, they distribute to you, they'll call dividend distribution. If the mutual fund earns capital gain and distribute to the investor, they'll call capital gain distribution. Practically, do not ask me what they call. Theoretically, it will be these terms used. Fourth point. This was fourth. Now, mutual fund returns the return to the investor. Fifth point. It is an indirect way of investing in the market. It is an indirect way of investing in the market. It is an indirect way of investing in the market. So what does it mean, indirect way? You are taking part of the growth story of India via mutual fund. And generally mutual fund, if you stay invested for 5 to 7 years, sorry, you'll get very decent return. Nowadays, the return comes in a 6 months only, and there could be possibility first 6 months return will come, next 6 months nothing will come, and then another 6 months nothing would come, and then suddenly in 2 months huge amount of return would come. But on an average, we have seen the history. Those who would have stayed invested for a longer period of a time, the return comes higher. But yes, risk is involved. Risk could be there because it's your money, and certainly advice which anyone gives, even the advertisement which comes on television, they'll tell you not to invest at one go. Invest systematic investment plan. That means keep investing small amount every month. That will be help you to reduce your exposure. Now I'm drawing a chart which you can see once. This is investor. He'll give money to the mutual fund. Mutual fund will invest, generate some return. This is the entire cycle. Investor gives money mutual fund. Mutual fund invests in the market, generates the return, and returns back. This is the entire cycle. You can copy quickly. Investor gives money to the mutual fund. He will generate some return, invest in the market. From there, they generate the return and then returns back to the investor. Quickly copy that part, please. Investor gives money to the mutual fund, invests in the market, generates the return, and returns back to the. Now, the next note, which I'll not dictate, which you can study from the theory when we get that book at the end. Formation. There is a trust, there is a sponsor, and how the structure happens. Portfolio managers, the people who manage this is called portfolio managers, and they run the show. So there is a structure formation of the mutual fund which is not required. What is required for me practical purpose is, I'll show you difference between, you've done this part, I'll show you difference between when you invest directly and when you invest via mutual fund. What are the terms used, so that you are clear between both of these structures. Put down, please. Put down. Is happy investor. Either he'll invest in company, or when you invest in a company, you get what? Shares. When you invest in mutual fund, you'll get units, can be in decimals. Shares cannot be in decimals. Although I think talk is going on fraction, but I don't think it will be materialized or not. But shares as of now are not in fractions. Units can be in fractions, points. When company issues share, in the liability side of the balance sheet, they write what? When company issues share, What they write when they raise money? What type of capital? Share capital. They write it as share capital. This will write as unit capital. The people who buy the shares are known as what? Shareholders. And these people will be known as unit holders. The companies is listed in the share market. Company is listed in the share market and it is known as what? Share price. What trades in the market is share price. And this will be known as what, sir? Net assets value. Is this traded in the market? To some extent. There could be some listed, some unlisted. This is our objective of the class, to calculate NAV. How do we calculate? You will come to know in half an hour time from here. Net assets value, NAV. Now I am drawing a structure of the balance sheet of a company. What does happen if it's a company balance sheet? If it's a company will show what? Share capital here, and there will be some what? Reserve surplus here. When the money comes, they'll invest in what? Plant and machinery, furniture, etc. And they buy what? Some amount will be cash. Similarly, when there is money, it will be unit capital, but their objective is not to buy furniture, fixtures, etc. Their objective is what? To invest. It will be either investment and balance would be cash. Then they can keep generating return, either they distribute or become part of their NAV. Basically, purpose is to explain this part here. Purpose is to explain this part here. That means with the money what they raise, the objective is to run the business, plant and machinery, furniture, and their objective is to make investment. Balance left is what? Cash part. Our first topic will be first part of the chapter on which question come is to calculate net asset value, NAV, and NAV would be per unit. That's the first objective. So let's put down the heading as first note or first heading practical. Net assets value, NAV. Net assets value. Net assets value would be equal to total assets value minus outside liability, and it will be always per unit if nothing is said, divided by net assets value is total assets value minus outside liabilities. Sir, how do we calculate the total assets? It will be all type of investment plus whatever is the cash balance and whatever is standing on the asset side. What items can come? There could be investments, there could be some dividend accrued which company has made investment in some, the mutual fund has made investment in some company and dividend has been declared but not paid. That will also reflect some part. These investment, what do you think would be at market price or the book values? What do you think? Investments, you know, when you buy the share, every day you find what? Share price going up, share price coming down. You know how to buy. Let's suppose today I invested in mutual fund. The value at which I invest is known as what? Net asset value, NAV. Starting of the day it is 10. Then for example they raised some money, they made some investment, and then investment value went up. What do you think? Do you think my net asset value will go up? If I invest in the mutual fund and mutual fund has invested on my behalf, the investment where they made, the value of that investment went up. If the value of the investment went up, the value of the total assets will what? Go up. The investments are always valued at market price. For example, if the market closes 3:30, I think by 7:30 in the evening, around 7:38, they'll start reflecting new net asset value. Sir, why? Because if someone has to buy the units tomorrow, he will not get a 10 rupees again, because I made 10 rupees and today the value has gone up, it has become 11. How would he get a 10? If everyone was getting same, I would go back and invest at 1995 price. It is not possible. Think of a share price. What share price was appearing on Friday, the same share price is not appearing this Tuesday. If someone has to buy, he will have to buy at what? Today's price. Now Tuesday market is closed. If I have to buy in a company, I'll get what price? What is opening tomorrow. Similarly, if I invested in a mutual fund 2 years back, that price cannot be same today. That price would be basically what? Nothing but net asset value. And it will, sir, it fluctuates. It fluctuates. This investment is taken at what value? Market value. If the market value of any particular asset is not known, then we take the book value. So the investment would be taken at a market value. It means if, for example, in the last 2 days, market has what? Gone up, na? Automatically, you know what would have happened? The NAV of the mutual funds would have what? Gone up, depending on if they had same shares, which has also gone up. So if anyone would have invested in Friday and if anyone is investing tomorrow, will not get same price. So by today is Tuesday, by 8 o'clock we'll have new prices being reflected, and based on that new prices tomorrow, the anyone who's selling or buying will take place on that part. So total assets, when we say here, I'll dictate a note below this. Put down a note. Put down a note, please. Assets would be calculated at market price. Assets would be calculated at market price. Assets would be calculated at market, full stop. In case market price is not available, in case market price is not available, then they would be taken at, then they would be taken at book values. In case market price is not available, then they will be taken at book values. Second point, what will come in, sir? Outside liabilities. In outside liabilities, it is unlike companies, for example, where you have a creditors, where you have some other outstanding, etc. These will have only two type of outstanding. There could be some expenses outstanding which are relevant to the mutual fund. There could be some expenses outstanding here, or there could be possibility that mutual fund has bought some shares from the market and they have not paid the amount. But technically nowadays it does not happen, because same day payment is taking place. For the theory purpose, they can give it to you. Amount payable on. These are the only two items you might find which could be outstanding in case of the expenses outstanding and amount payable on the. What I'll do is I'll do one question in which it will be ultra clear to you what level of questions comes. One part of the chapter is this. Actually, in two parts chapter will come. I'll go back to my initial chart of the mutual fund. Two calculation would be done. One at the mutual fund level, calculation of NAV. Second would be returns from the investor's fund. In entire two things will summarize the chapter. But yes, questions of the late in the last 2 years or 3 years have started coming slightly indirect way, means not the straight way. But objective is what we are doing now, calculation of NAV, we are doing in whose hands? Mutual fund. Sir, why I need to calculate mutual fund NAVs? Because if I have given some money to the mutual fund and after 4 years time I'm selling that mutual fund, I should know what rate I am selling, and then only I can calculate return in the hands of the investor. Calculation of NAV is not tough, and calculation of return is not even tougher than that. It's the simplest part you'll come to know with this single question. Can we look at the questions now? Come back now. Can open up book we have. Come back. If you have the book, it's okay. Otherwise, I'll show you the question. Don't worry. If you have the notes, fine, or you'll get soon. Nothing to worry on that. Question number 14. Question number 14. If you have, that's fine. If you do not have, nothing to worry, please. Just read that question quickly. It generally comes for 8 marks based on the following information. Determine NAV, net asset value of a regular income scheme on per unit basis. Even if it does not say, we'll calculate on per unit basis only. Rupees in crores. Listed shares at cost 20 crores at cost. Cash in hand 1.23. Bonds and debenture at cost 4.3. Of these, bonds not listed and quoted, that means they are not traded in the market, 1. Other fixed interest securities are at cost 4.5. Dividend accrued 0.8. Sir, what is this? This could be the dividend which mutual fund has to receive from the companies they have invested. It's an asset. Amount payable on share, this is liability. Expenditure accrued, this is liability. These two are liabilities. These two are liabilities for the company. We'll do it verbally. Format I'll put, don't worry. Number of units 20 lakh. Listed shares were purchased. Look at this now. Listed share, that means these shares were purchased when the index was 1000. Present index is 2300. So what does it mean? It means I bought a property. I bought 1000 square feet property when the rate of the property was 4000 rupees per square feet. How much amount I spent? I bought 1000 square feet property when the rate of the area was 4000 rupees per square feet. I spent around 40 lakhs. Now the rate of that area has become 7000 per square feet. If I ask you, if I sell my property today, what is my capital gain? I bought 1000 square feet, rate was 4000 rupees per square feet. Now the rate is what? 7000 per square feet. You can calculate answer similarly. What is the cost of the share? 20. He bought when the index was what? 1000. Now the index has become what? 2300. Can you tell me what the value will become? 20 is with respect to 1000. That means 20 divided by 1000 into what? 2300. Can you do that calculation? Yes. Value of listed bonds and debentures. If any market price is given, we'll take market price. And he said here, if I go back, I clean up the exercise here. He said bonds, total bonds and debentures are here 4.3. Out of these, not listed is only 1. That means rest of the part is what? Listed. I do not even want to know how much is the listed part. I just want to know what is the value of my listed shares. How much is that? 8. Then he says there has been diminution of 20% in unlisted bonds and debentures. That means value of the unlisted bond and debenture has fallen down by 20. That means how much is the unlisted bond? 8. It becomes what? 0.8. Other fixed interest securities are at cost. Even if it does not use this line, I'll assume what? They are at cost, book value only. Now without doing a format, help me out the numbers please. Should get the confidence. It's a 8 marks question. I've been asked I think 3-4 times. 20 crores, I bought what? 1000. Now the value is what? 2300. So I can do here 20 by, you do not have to copy, please just help me out. I'll make in the format, don't worry. This will become what? 46. Cash in hand, what value should I take? 1.23. Out of 4.3, leave apart. We do not want to know whether how much was listed, unlisted. I know the listed value has become what? 8. So I'll put here what? 8. Unlisted value, he only told us, has become what? 0.8. 20% diminution. Sir, where did he gave? He gave here. That means, sir, basically the 3.3 here has become what value? 8. So we do not even want to know. It's okay. Other fixed interest security. Did he say anything? No. If it does not say will take, he said it will be at cost. Even if it does not say will take at what? Cost 4.5. Dividend accrued 0.8. These are my total assets value. Tell me how much does it? You should get the confidence of doing these questions verbally, please. 20 crore cost will become 46, 1.23. It's 8.8, 4.5 and 0.8. How much do we get? 61.33. This is my asset. And total of the liability, tell me. Total of the liability, tell me. 7.07. And assets minus liabilities, tell me the total net asset value. Total NAV 61.33 minus this 54.26. Be careful, this amount is in what? Crores. Now, only mistake which a student generally make in exam is when you calculate NAV per unit, it will be total asset minus outside liabilities divided by what? Number of units. This amount is in what? Crores. Units are in what? Lakhs. Be careful when you divide, it will not be divided by 20, it will divide by 0.2. In lakh you have a 5 zeros, in crore you have a 7 zero. Either convert crore into lakhs or lakh into crore. That means I'll divide 54.26 divided by 0.20 crore. 54.26 divided by 0.20. How much do we get? That's NAV per unit. This is the area of a mistake. If you have the book, please highlight this. This figure is in lakhs. I'll keep telling you what could be the area of the mistake. It's 54.26 divided by 0.2 crores. How much do we get? 271. I think 4-5 times or maybe more than that they would have asked this question. If your luck is there, this question would come. You cannot expect to lose a marks. Only thing I have to tell you is how to make a formatter. Can you do formally now? I hope you got the point. If any market value is there, I'm just helping you out what we have done the note. If any asset has a market value, we'll take what? Market value. If market value is not available, we'll take what? Book values. Is that fine? Let's put the format. In case anyone has the note, I'll do one thing. Do not take my photo. Want to take, you can take the photo of the question in case anyone wants to take. Otherwise, you will have the book or I'll share the notes, whatever the case. Can I draw the format? It's an 8 marks question, so I'll do the format accordingly. Calculation of, it's number 14. Calculation of NAV per unit. Even if it does not say, we'll calculate NAV per unit only. 3 columns will make particulars, basis, amount would be is crores. So what is basis? Either market price or book value. First, we are picking up assets here. First assets were listed. Book value or market price? Market value. And way of calculation was, he said, have sir 20 crores when the index was what? 1000. Now the index has become, you can do an argument if you want to do, sir, has the shares increased proportionately? If nothing is said, yes, proportionately. Means 1000 rupees, you bought 20 crores, now the market has become what? 2300. So your value would have increased proportionately. It became what? 46. Second is cash in hand. What value? Book value. Amount I'll show you. It's 1.23. So where are we taking this value from? I'm taking here 1.23. Next is what? Listed bonds and debentures. Now do not get worried, sir. Out of this listed, some were unlisted. How does it make a difference to me? Even if you do a 4.3 crores divide into listed and unlisted, I need to know what is the value of this, what is the value of this. That's it. Proportion I'm not even worried about. So I have listed bonds and debenture. What value? How much I said? Question gave you 8. Unlisted bonds and debentures. And he has given for unlisted bond and debenture, the value will decline by 20%. The book value of the unlisted was what? 1 crore. And you know what will take? Market value only. How can, sir, unlisted bond has a market value? Anything can have a market value. Land has a market value. Market value is basically what is different from the book value. In books, they were appearing at what? 1 crore. The market value would be 80% because he said there is a decline of what percentage? 20 percentage. Sir, unlisted bond and debentures. So I'll do it here. It's I can write, sir, here 1 crore into 80%. That's 20% decline with 8. Next item is what? From the book, anyone can tell me? Other fixed interest securities. He said take it at book value. Value was 4.5. This 4.5 and then dividend accrued is 0.8. 4 point dividend value 0.8. I think these are the only assets now. This I can term as total assets. Total assets value. Tell me how much? 61 point 61.3. Then we can write what? Liabilities. Liabilities. In liabilities, we'll write amount payable on shares. What value? Book value. 6 point. And then we have what? Expenditure. Good. What value? Point. Point 7. Total liability. 7 point. Next line. Why? Okay. Let's do it here only. Total. total net assets value. Total this will be, sir, A minus B would be 6.32 crores minus what? 7.07. 61 point, no, 54 point something, na? Oh, sorry. 61 point, you said 54.26 crores. Then we have, therefore, NAV per point 271 point, 271. Now we'll do a similar type of a question, but every question will have one new point, which will be exactly same way. If you remember your 11th class or maybe the foundation CPT world, you would have done profit and loss balance sheet. Then there used to be some adjustment. Out of the 10 adjustment, 8 used to be same, 2 new adjustment used to come. Whether I tell you or do not tell you, I'll always highlight that this is the new adjustment. That would mean when you're revising in the exam, you will not be doing all questions. You will only focus on that particular point. For example, in this part, I know mistake would be done at this 20 lakh. It's a very high chance. So you can highlight this. You have to be very careful. It is in lakhs and amount is in what? Crores. If I put a focus, it's fine. If I do not put a focus, it's your responsibility. Please mark it, because while explaining, I'll put focus on what is the new point in this question. This was 14th. Similar question we have is 26th. You will find exactly same. 26th will find exactly same. There will be one new point which will come. I'll read out with you, or you read once, please. At least small part here. Everyone can read. 26th. You read once, then I'll read out with you. In fact, I'll not even make the format. You have the format ready with you. I'll just take the numbers from your side. Based on the following data, estimate NAV on per unit basis of a regular income scheme of a mutual fund. Everything. First point, listed share at cost, same. Cash in hand, exactly same. Bond and debentures, 8.96. Not listed, not quoted, exactly same language. Other fixed interest securities, 9.75. Dividend accrued, 1.9. No change in the language till here. Then he says amount payable on shares, and this is accrued. So nothing is new. New will come now. Current realizable value of fixed income securities of face value 100 is 96.5. This is one point. This is new point for you. 100 rupees is 96.5. So automatically you can tell me if 100 rupees becomes 96.5, then sir, this is talking about this. Can you tell me what would this becomes? If sir 100 rupees is 96.5, then 9.75 lakhs would be what? So 9.75 divided by what? 100. That means if this was equal to 100, and value will become equal to what? 96.5 be equal to how much? 9.41. Sir, how many decimals? You can leave it 2 or 3. So question will mention, since it's a lakh, you can even do 3 decimals. And rounding of decimal would be what? If it's 5 and above, it will be high rounding off. If it's below 5, for example, if it is 9.416, it will be 9.42. If it is 9.413, rounding out would be 9.41. So that's basically 100 rupees becomes 96.5. So 9.75 lakh would be equal to 9.41. This is first new point. Second point now when we move. Number of units 2,75,000, no challenge. All listed equity shares were purchased at time when market index was 12,500. On the NAV date, market has become what? 19,975. So you can tell me that value also. It is 40 lakh divided by what? 12,500. 40 divided by 12,500 into what? 19,975. So this will be 12,500 into what? 63.9. Very good. No new. Diminution of 15% in unlisted bonds and debenture. Where is unlisted bonds, sir? 2.5. So can I multiply 2.5 into what? 85. Sir, why 85? 15% decline. 15%. How much do we get? 2.125. 0.12. Next part. Listed bonds and debenture carry market value of what? 7.5. So we'll do what? Sir, will 8.96 be 7.5? No. Neither we are concerned. Out of this, some part is already taken here. Balance part, since it says market value, what is the market value? 7 point. Sir, what was this? 63.9. Now left is what? Dividend accrued will come as it is. 1.95. Last part. Last part we have. Last part says operating expenses paid during the year amounted to 2.2 star. Put a star mark here. This is new point. Operating expenses paid during the year 2.24 lakh. Since you are doing it for the first time, I'll ask your opinion first. What should I do with this 2.24 lakh? It's paid during the year. No, accrued expenses are already accrued only. Accrued is accrued. If you pay something, it will adjust it in what? My objective is, should I reduce the cash or not? That's the question. Now, any opinion can be there. It's basically, actually, practical life, it does not happen. Practical life, when you're looking at some numbers, you know they are standing on this date, or they are 6 months back, or the expenses was paid after the closing of the books or before the closing of the books. You know what I'll do in the exam is, this is already adjusted. That means these balances what you have are closing balances. So how would I know looking at the language? I'll show you some of the languages of the question. How would I know, should I adjust the expenses or should I not adjust? In this question, has he mentioned any date anywhere? If you look at based on this blah blah blah, these are the figures, that means they are already taken care of any kind of expenses. Now look at 27th language. 27th language of 27th is, on which date we are standing? 1st April. You do not have to write anything, just look at the screen. 20 lakh units issued at what rate? 10. How much amount collected? How much? 2 crores, so 200 lakh. Relevant initial expenses involved what? 12 lakh. Should I make a payment from here? Yes, because if you look at the last line, you have to calculate NAV on which date, sir? 34. That means anything which happened between 1 4 2012 and 34 2012 should be adjusted. This is one language. Let me show you some more. And when I am showing this, you can always write with the 26th question. Compare the language of question number 27. Compare the language of question number 11. So that you know, when you compare the language, you'll come to know. For example, look at this. 11th question. No need to flip over your pages. Just the screen, please. It says Mutual fund issued 10 lakh units of what each? 10 each. How much amount collected? 1 crore. And then he bought some investment of 98 lakhs. Balance would have been maybe cash. And then he says during the year dividend was received, interest on all type securities was received. Basically, he's invested in the equity and he has invested in the debt. So he has received interest also, he has received dividend also, cash balance would have gone up. And then he says at the end, blah 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 blah, etc. etc. Given that operating expenses paid during the year was 5 lakh. Should I now subtract in this or not? I'm asking you, I'm taking your opinion. He started on January 1, he collected some cash was adjusted, then during the year something happened, and during the year he said, I paid some expenses. Should you make a cash balance accordingly? Opening cash balance, dividend received, interest received, expenses paid. Yes or no in this question? Yes, you'll be doing it because this question is basically what? Basically, it's starting of the date. January 1 you're starting, and during the year some events have taken place. So you get to know from the language whether you have to adjust for the expenses or not. In 26th, prima facie you can do the argument, sir. How do you know that cash balance was adjusted or not? I do not know. If you feel uncomfortable, go back home, write a letter to the institute. Dear Mr. Institute, how do we know whether cash was adjusted or not? And their reply will come. Then tell me whatever reply comes, will come. It is adjusted. If you feel discomfortable, only thing we can do is practical life. You will not have the challenge. Practical life. Why the challenge is not there? I know whether we are taking the closing balances or we are taking 6 months back balances. In this examination pattern, this challenge will remain, and you will have the challenges in the question. I can tell you, final level only problem comes is language is so unclear sometime, different opinions will come. And in this case, it is not even opinion. Especially in this case, there is no opinion because I know if he gives me clearly the opening balance, I have to first make closing cash balance. This is already adjusted. So you can highlight here operating expenses, ignore. You can write ignore, it is already adjusted. And with that, you can write look at the language of question number 11 and look at the language of question number 27, that when you go back and revise, because now you are very clear, it's fresh. After a month time you will not even remember which question, which chapter or which subject are we studying. And after 3 months, just before 2 months or 1 month before the exam, you will not even know that we have studied this subject or not, because pressure would be so high, intense pressure of the examination. Write everything, smallest to smallest point, please write in the copy. I'm saying it again because ultimately it's difficult to remember. It's not about you, it's about me also. Since I teach one subject, I remember this day in, day out. For you, it will be multiple number of subjects you'll be doing. Please write everything that why have we ignored? First language was nothing was said, we assume these are the closing balances. In exam, you did not write the note. You have the format, you will do in the format, and I'll do it here only. Just help me out since my question is over now. This will become what? 2.76. This is 2.76. So you can tell me what total value? Tell me the total value. 87.665. Tell me the total asset value. Format I'll tell you so that you get comfortable. I'll give you time to do. It's 63.92 what we calculated. Cash balance as it is. This 7.5 was given. Diminution was 15 percentage. This was 100 rupees 96.5, 9.41, and this 1.95. Tell me the total value what we get here. Anyone who has done? 87 point something should come. 87.66 only. I have a hearing problem actually. 87 point Nalaik. 87.665. That's total assets. A value. Tell me the B value also. Total of B. 15.3. Now you can tell me the total assets value. That means 87.665 minus 15.3. 17.72.5. This is in lakhs. Yes. So what you can do is NAV per unit. I'll do it here. NAV per unit would be equal to 72 point. Just tell them we are coming in few minutes. Oh my god. Divide by 2.75 lakh. 72.365. Sir, 2,75,000 is 2.75 lakh. How much do we get? NAV? 31. Now you can put in the format and now you can put in the format, quickly finish it off please, so that you get habitual of the format. For me the format is ready. Even if I put, I'll just reduce that and do it. Quickly do it please. Try not to look at the format and do it on your own. Make it so that it freezes in your mind. Quickly make the format please. Let me know once you've done. We'll do small note one more. This is actually the first part of the chapter. Once you've done this, I'll today itself cover a small note on the second part. Just make sure you do not make a mistake, please. Done. I'll cover up a small part before we move to the next type of variety of questions. This was done in the hands of the mutual fund to calculate the NAV. Reason was, if any investor is investing, he should know what rate I would be quoted. For example, whatever NAV came here 26.314, if I am investing today, I should be charged 26.314 plus there could be charges if they are additional, or if I sell prima facie, I would be selling at 26.314. So buying and selling rate is basically the NAV. It is just like the share price. Since share prices are traded regularly, so you do not have to worry about it. But in this case, if they are unlisted, there has to be some value which is there. So NAV per unit gain. Everyone has done this part. Can I move forward? I'm assuming you would be able to do it. It's only format was pending from my side. The answer was 26.314. Let's put down second note, which will be basically from the perspective of the investor. From the perspective of investor, sir, what does it mean? It means if I am investing in the mutual fund, I want to know what is my return in hand. That is called computation of return. This is second part. Now, before I dictate a formula, let's create a formula, please. I'll create a formula. Zero period, 12 months. Zero period, 12 months. Dividend. Do not copy, please, anything. Let's suppose, do not copy anything. Give me a time, please. I'll give you a chance to do it. Tell me from the layman's perspective, in zero period, I invested in the mutual fund when NAV was 10 rupees. During the year, the mutual fund has paid me 40 paisa as dividend, and they have distributed capital gain distribution, I'm saying, as 20 paisa. After 12 months, NAV has become rupees 11. If you have to tell someone your return, what would be your return? I'm using data once again. 10 rupees I invested. At the end, it became 11 rupees. So this is nothing but it is my unrealized capital gain or appreciation of the value. During the year, two type of return mutual fund has distributed. One is form of dividend, second in the form of capital gain. So this has come in my hand. If you have to tell someone what is your return, you have got two type of return. One in the form of the realization, that is 40 plus 60, and one is unrealized. So my basically formula would become what I'll say, sir, 11 minus 10 is my unrealized gain plus 0.60 divided by what? 10. You invested what? For example, let's suppose I invested in a property. I purchased a property for 50 lakh. The value of the property at the end became 60 lakh. If I calculate my notional gain, how much is my gain? 60 lakh minus 50 lakh, you calculate na? Similarly, this will be 11 minus what? 10. That's unrealized. If you sell, it is a realized gain. If you do not sell, it will be unrealized gain. Now, if you wonder, sir, how it became 11? It can become 11 because the investment, what was done by the mutual fund, the value of that investment would have increased. And during the year, I received some rent. Property I'm talking about. Received some rent. So, rental income is my realized income. Appreciation in the value of the property is unrealized. So, my gain would be what? 11 minus 10 plus 40 plus 20 divided by what? 10. What is my percentage gain? 60? 1 6, whatever the gain comes. So my formula becomes what? My return formula becomes dividend distribution plus capital gain distribution plus NAV1. I'll call this as NAV1 end value. This I'll call it as NAV0. So I can write my formula: NAV1 minus NAV0 is my unrealized dividend distribution plus capital gain distribution. Sir, what is this distribution? This is basically, if I'm a mutual fund, you have given money to me, I would have invested in the market. From market, I earned some return, and that return I'm distributing. If I made income in the form of dividend, I'm distributing that as a dividend. If I made some income in the form of capital gain, I'm distributing that as a form of capital gain. So we call that as a dividend distribution, capital gain distribution. This is exactly, if I go in this line chart, it says, what has this become? This is basically, you gave money to the mutual fund invested here, they got some return, and that return is returned back to you. That's it, exactly what is happening. So let me create a formula. If you want, you can copy the diagram. I'll make the example also. And please try to create formulas on your own. You will not never forget the formulas. My return formula is equal to, dividend distribution plus capital gain distribution plus NAV1, NAV0. Sir, what is NAV1? NAV1 is end NAV, divide by NAV0 is beginning, into 100. Exactly same data, I'll create the example. Exactly same data, you can copy the diagram if you want. So does this question come? Earlier this question used to come for small marks. Now this has become part of the lengthier questions. Dividend distribution is 40 paisa. Capital gain distribution is 20 paisa. NAV1 is 11. NAV0 is 10. Into dividend distribution and capital gain distribution is technically known as realized gain or realized profit. Dividend distribution, because you have realized it, and NAV1 minus NAV0 is unrealized. That means basically it is increase in the value, appreciation in the value, and if you by chance sell, automatically becomes realized value. Numerator becomes how much, sir? 1 point. I'll show you the question what exactly comes. Once you've done, let me know. Done. Look at the question, which used to come, now they do not come generally, they become part of the lengthier questions. Can I go back? Come to question number 5. Small question you have. Number 5. It says a mutual fund that had a net asset value of 20 lakh 20 rupees at the beginning of the month. Please be careful, it's the beginning of the month. Made an income and capital gain distribution of 0.035 and 0.03 per share. It should be per unit actually. Language of your institute only. During the month. It's month only he's talking about. And then ended the month with a NAV of 20.06. So this is my NAV0. It's a month NAV, and NAV1 is a month NAV. Calculate month return. Only 1 month. You have to be very careful. Sometime I've seen in the exam they ask for the annual return, and students end up giving the month return. There could be reduction of 1 mark or 1.5 marks. If it's a 1 month, the return which we'll get is a 1 month. If you have to convert in full year, it will be divide by 1 into 12. Do it normal way. That's it. Let's put down this, please. The only application of the formula, nothing else. Solution 5. Small space here. Computation of return. Computation of return. Dividend distribution plus capital gain distribution plus NAV1 minus NAV0 into 100. Dividend distribution plus capital gain distribution plus NAV1 minus NAV0 divided by NAV0. The dividend distribution is 0.0375. The capital gain distribution is 0.03. It's 0.03 plus 0.03 plus what is my NAV1? 20.06 minus divide by, get some number. Tell me the numerator. Numerator. Total. 0. No. After point, tell me point. How much is the numerator comes? Alright. Before point, 0 confuses me. Tell me after point. 0 point, na, point only, tell me point. Alright. Point 0.1275. Evening effect. 0.6375 percentage per. If I ask you, I'll add one part from my side, return per annum. Anything which I make under the clouds is part of seva. You know what is seva? Hindi also seva, English also seva, I think, Telugu also seva. What is seva? God gift? Eh? Seva. You know what is seva? Plain. Seva is what? Ah, seva is seva, na? Seva is seva. You do not get anything in return. Prima facie. Else God gives you, that's fine. Exactly what I am doing as a part of seva, you will not get any marks for it. It's only for a reference purpose. Objective was to tell you what seva is now, right? That is why I was telling you English is so very difficult language. What seva should we do? You told me do seva. What seva should I do here now, right? Per? That's it. Why are you worried? Become a teacher sometime. Become a paper setter, in fact. I'll try my level best how the examiner thinks when setting a paper. How does he think? You have to think from his perspective. The moment you start thinking from his perspective, you'll come to know, because there will be some questions in your course which will have, especially the case study type, for example. Although I don't know what kind of a case study they'll give, I have taken from your institute material, reference material sometime back, in which he'll have a point, B point, C point, and D point. D point will be unclear, but you have to read that point with respect to the ABC. So there will be something of that sort. Return per annum. If by chance he gives you return per annum, then please simply do it. Although we can say effective, etc., but simply you have to do is, if 0.6375 percentages per month, multiply by what? You'll get some number here. 7 point. 7.65 percentage per annum. Done. We'll wind up here today. Next questions are slightly lengthier. So if some of you do not have the books, please carry them. It will become easier for you to know it. This will be applied now. Next class onwards, what we'll do is what you calculated NAV, what you calculate return, I'll combine both of them. And then some permutation, combination, reverse calculation, front calculation, so on. So you've got the feel of the chapter. The basic class today and tomorrow, tomorrow also I'll keep slightly lighter. After that, I'll start assuming that you come into the flow, and then we'll start moving it. But till that time, please make sure that whatever you do, keep revising it and keep highlighting some points here. That was, we'll wind up here. I'll see you tomorrow. Take care and bye bye.